Hello, this is Mr. Smith, and this is the daily participation. Please click on Submit, and a text box will open up, and type in 3 significant items from today's lesson. So the Federal Reserve is a central bank that was designed because of the economic panics that have been happening during the Industrial Revolution. There was a great amount of growth, but the problem is because of that growth, there was also overinvestment and overloaning. And whenever those fell through, of course, then we had a bubble that was burst, and we had a panic, people running to the banks to pull out all their money. And so there was twin decisions that were eventually made. One of them would be the creation of the FDIC to ensure those accounts so people wouldn't panic as much. But the other one would be, in 1913, actually, the establishment of the Federal Reserve System, which was because of one of these panics that happened a little bit earlier. And the concern over something like 1907's panic had kind of festered for a while, the discussion about whether this should be a solution by the government or the private sector and so on. And so eventually, by 1913, they come to a resolution that there would be a central bank. It would be government appointed and approved leadership by the president and Senate, respectively, but it would still, the infrastructure of it and the organization of it would be made up by the private sector, mainly through nationally chartered banks, banks that are for profit. They're businesses, they have stockholders, they have CEOs and their own employees and so on, but they would make up the infrastructure of the bank. So the Federal Reserve System would be born in 1913. And when President Wilson signed the Federal Reserve Act into law, it stood as a classic example of compromise because it was a decentralized system and a combination of public and private sector involvement. So it was eventually open for business by 1914, and there'd be others involved in making sure it got set up, like the Reserve Bank Operations Committee in Congress, which are approved by Congress, which would be made up of the Treasury Secretary and the Secretary of Agriculture, since they're involved a lot in the economy at the time, and the Comptroller, which is a person that controls currency. They have the task of building this working constitution basically from scratch and making sure that all of these different nationally chartered banks will be able to work together and so on. And so they eventually chose 12 sites for regional reserve banks that were open for business. And this was just, of course, in time for World War I. And during World War I, from 1914 to 1919, U.S. banks basically continued to operate normally thanks to emergency currency issued under the Aldrich-Vreeland Act of 1908, which had happened previously. So they still had funds. But the greater impact in the United States came from the Reserve Bank's ability to discount bankers' acceptances. Through this mechanism, the United States aided the flow of free trade goods to Europe, indirectly helping to finance the war until 1917, when the United States officially declared war on Germany itself and got involved. And so this mechanism allowed them to, like I said, be an indirect supporter financially. And as acceptances are promises of future payments. And with that discounted rate, of course, it became more affordable. So therefore, the money can flow to Europe, to the future allies, and they can be able to spend it without the worry of too much of a financial penalty. Then in the 1920s, we began to see the beginning of open market operations. It was recognized that gold no longer served as a central factor in controlling credit. There was a suggestion to put off a recession in 1923 after World War I, that there be a large purchase of government securities that gave clear evidence of the power of open market operations to influence the ability of credit in the banking system. So it was basically seen, we did this with bonds, we were purchasing them, it put cash into the economy. That was proof, of course, that we have the ability to influence the economy. So during the 1920s, the Fed began using open market operations as a monetary tool. And one particular individual involved, Benjamin Strong, which was the head of the New York Federal Reserve Branch, promoted this idea a lot. And New York is the most influential branch out of all of the 12. And so this idea that they could use purchasing, buying, and selling of bonds as a mechanism to influence the economy became even more popular. From 1929 to 1933, though, the Federal Reserve was seen as maybe not having as big of an impact in preventing or at least trying to tamp down some of the negative effects of the Great Depression. There were warnings that the stock market over speculation could have terrible consequences, and this, of course, seemed to come true in October of 1929 when the stock market crashed. Nearly 10,000 banks failed between 1930 and 1933, and Franklin Delano Roosevelt, after he was inaugurated, declared a bank holiday, closing all the banks to prevent panic so people wouldn't be going in and pulling out all of their cash. And many people, of course, blame the Federal Reserve for failing to stop all of the loans that had been put out and overinvestment in the stock market and so on. Some argued that the Federal Reserve did not have adequate understanding of monetary economics going forward. So in 1933, Congress passed the Banking Act of 1933, also known as the Glass-Steagall Act, calling for the separation of commercial and investment banking. So if you were a bank, for instance, that was involved in typical banking, taking deposits from people, loaning out money, you also couldn't be involved in investing. And this also officially established the FDIC. So this took a little while after the Federal Reserve was begun, but the FDIC was established, the Federal Deposit Insurance Corporation, to insure accounts. So people, if they heard the bank was having trouble, maybe they wouldn't be as likely to run down to the bank and pull out their money. But it also officially gave open market operations to the control of the Federal Reserve and required bank holding companies to be examined by the Fed. And so it would have more involvement in the supervision of the banking system. This would have a profound impact on future implications. And these reserves, or these powers, ended up helping the Federal Reserve prevent future Great Depressions from happening. There was also a Banking Act in 1935 passed, which called for further changes to the Fed structure, which included making a Federal Open Market Committee, or FOMC, so bringing even more prominence to open market operations. And following World War II, the Employment Act added the goal of promising maximum employment to the list of the Fed's responsibilities. And throughout most of our modern history, that's between 4 and 6% unemployment. And by 1956, the Banking Holding Company Act named the Fed as the regulator of bank holding companies, so companies that own banks, especially if they own more than one bank. And the 1978 Humphrey Hawkins Act required the Fed chairman to report to Congress twice annually on monetary policy goals and objections. In 1951, we have what is known as the Treasury Accord. The Federal Reserve would formally commit to maintaining a low interest rate peg on government bonds in 1942 after the United States entered World War II. It did so at the request of the Treasury to allow federal government to engage in cheaper debt financing of the war. So once again, lower interest rates pegged on government bonds starting in 1942. And this, of course, had been after we had entered World War II in 1941. So to maintain the peg rate, the Fed was forced to give up control of the size of its portfolio as well as the money stock. And the conflict happened between the Treasury and the Fed. It came down to the wire. And so President Harry Truman and Secretary of Treasury John Snyder were both strong supporters of having this low interest rate peg. The president felt that it was his duty to protect patriotic citizens by not lowering the value of the bonds that they had purchased during the war. Unlike Truman and Snyder, though, the Federal Reserve was focused on a need to contain inflationary pressures in the economy caused by the intensification of the Korean Wars. Putting this peg in basically weakened their ability in open market operations, and that was their major protest. Many on the Board of Governors understood that forced obligation to maintain low peg on interest rates produced an excessive monetary expansion that caused inflation. So after fierce debate between the Fed and the Treasury over who gets control over interest rates, their dispute was settled, resulting in an agreement known as the Treasury-Fed Accord. This eliminated the obligation of the Fed to monetize the debt of the Treasury at a fixed rate, so they no longer had that peg there, and became essential to the independence of central banking and how monetary policy is used today. And this is kind of a jurisdictional turf war between one government entity, one semi-government entity, the Federal Reserve and the Treasury. So basically, they came to an agreement that this tool was needed, that the interest rate shouldn't be pegged, and that the Federal Reserve should continue to have open market operations control. In the 1970s and 80s, of course, we had problems with inflation because OPEC had formed. The oil supplying countries basically were saying, hey, we're making the world run and we're hardly getting any money out of it. So they pulled together in a cartel through collusion and agreed to lower the supply, which of course caused prices to go up for not only oil and gasoline and diesel and all the other types of petroleum-based products, but then everybody uses it for shipping, so all other products had prices go up as well. It was a cost-push example of inflation. And so this became one of the major concerns of the Federal Reserve. They had started under the guise of faulty banking and then got more power because of the Great Depression. Now it's going to focus on prices in particular to make sure there is not inflation or deflation, at least above certain levels. Inflation above 3%, and we don't want deflation at all, because if that's happening, it means that there's a depression. But over here on the side, you can see how the Federal Reserve System is organized. The central bank is the Federal Reserve. It's three main parts of the Federal Reserve Board of Governors over each of the 12 reserve banks, and then the Federal Open Market Committee, which takes those specific open market actions. And its key functions include conducting the nation's monetary policy. Remember, that's not the same as fiscal policy. Congress spends money. That is fiscal policy. Helps maintain the stability of the financial system, supervise regulation and financial institutions. So these two go hand in hand. Fostering payments and settlement systems of safety and efficiency. So loaning, for instance, to banks, and promoting consumer protection and community development. So this is the modern makeup. And the mission that has been set on, of course, this became even more serious with the Great Recession of 2008-2009, which we'll talk more about later. So they specifically want to keep kind of a fine line between inflation and deflation. In other words, they want to keep prices low, or at least not going up too much, but at the same time maintain economic growth.